celebrating 15 years of Young Turks.
Welcome back to Young Turks, back to the basics. I'm in conversation with Deepak Gaur, MD at SAIF Partners. Deepak, let's talk about what you see happen in the latter half of 2017 as we talk about consolidation that's going to take place. Clearly in certain sectors we've had too many companies of a similar sort come up, and M&A and the likes will be on the cards. What are the signals that you're seeing as far as that is concerned? And then of course I want to talk to you also about exits for a VC fund such as yours.
Yeah, so on consolidation, I think if you look at last 12 months, in smaller sectors there have been fair amount of consolidation, either because companies ceased to exit or shut down operations, or there was a lot of M&A at a smaller scale. And I think this trend will only accelerate across verticals. And the good news is that once this consolidation thing is clearer, you will, given that there is enough capital, it's not that capital has dried up, it's available but it's not being invested, you will see a lot of other transactions happening again, which will be very healthy again for the next level of growth for the ecosystem and companies. On exits, at least our view is that in our country it takes a longer time than what it takes in US and China, just because the growth is a little bit with more friction and the competitive intensity is higher. And so I don't think we budget any exit in less than 7 years on an average. And of course, if you have a source of capital which is coming from investors who have a 2 to 3 year investment cycle and want to exit in that time frame, then it's a big mismatch in terms of what the market can realistically offer versus what your expectations are. But if you look at it in a trend-wise manner, I think the market is maturing, because we are seeing a lot of investors who specialize in buying secondaries of other funds, and there have been few transactions like that. And at least we believe that this trend will only accelerate. You will see a lot of people who would buy out existing shareholders, and not just in one-off transactions but entire portfolios or part of their portfolios. So that's one very viable option of exits. You will also see public listings. Obviously there is a lot of talk about what the government is trying to do in terms of creating alternative exchanges or making the process easier. And over the next 2-3 years, who knows, maybe this will provide a very credible platform where at least some companies can raise capital or provide liquidity to investors. But
within your portfolio, do you still see another 5 or 6 year horizon for the current crop of investee companies to be anywhere near a listing?
3 to 5 years would be a better time frame.
Also, there is much made about the network effects kicking in. Then that's been one of the reasons why the larger players or the dominant players have had to try to chase market share in that sense. But do you think that that's not really going to play out in India in that sense?
See, for the network effect to kick in, one of the basic premises is that at least 1 or 2 players have a very large market share, because then they can use those adjacencies and sell more to the same customer. But if it is a segment in which that doesn't exist and there are still 3, 4, 5 players, then those don't kick in, and everybody is just subsidizing new customer acquisition. So
which is largely what we've seen happen in the last few years.
Across last few years.
All right. So you do think that it will remain a 3-4 person market, 3-4 entity market, and not a winner takes all?
Yeah, I don't think our country will be a winner-take-all market. It's just too diverse, and it is too important in market for very strong players to so easily concede and say that fine, let them take away. And it has not played out across any segment. If you look at telecom, insurance, banking, it's not that any sector.
The legacy sectors.
There's no sector which is winner-take-all. So I don't think this technology-enabled companies would be an exception.
There was much made about the unicorns everywhere in the world. Now that's somewhat become a bad word. Do you think that there is too much emphasis on the billion-dollar valuation, and perhaps, at least in the Indian context, we should rather aim for having many $100 million companies rather than the billion-dollar companies?
See, I think it becomes a very output metric for both investors and founders that this is one milestone of value creation that they have achieved, and that's where a lot of overemphasis on unicorns and $1 billion comes out. And I agree with you that if you take in $500 million and then you deliver a $1 billion valuation, it's not a great outcome. So even if you take 5, 10, 20 million and generate a $200 million outcome, it is a great outcome. And perhaps it is a sign of that our market is still very young, and hence that was the focus. But over time we will see pockets of markets which are focused on creating large outcomes, markets which are focused on creating moderate size outcome but more capital efficient, and that has to happen. Just a unilateral chase of creating unicorns will not help us. And not every problem can generate a $1 billion outcome. But there is no shortage of problems in our ecosystem and environment. So every problem will eventually get solved.
As far as the venture capital industry is concerned, where are we seeing this head? We did see a lot of angel activity, a lot of new class of angel investors emerge, and for an early stage fund, largely early stage fund such as yours, what has the development of that angel ecosystem meant? Have you seen better quality deals coming to you?
So overall, it is still very positive. I think what happens little bit which is not great for the overall journey is that many people got drawn to angel investing with expecting a very quick return or not completely understanding the risk reward, that it is a 10% or 5% success rate business, and if you do 2-3 deals you cannot expect it to generate a great return, and that could hurt us a little bit because I meet a lot of angel investors who have invested assuming this is short return or do not fully understand the risk. It is in a relatively younger stage.
Okay. So Deepak, winding down this conversation, what is your piece of advice to young founders who perhaps are listing down 50-60 ideas that they want to work on, then trying to business model around it? What would you like to tell them as a piece of advice?
Yeah, I think I have just 2 pieces of advice. One is that whatever problem or business idea that you have, do validate it very significant, with significant work, even before you start out, that it is a real large problem. Because many times we get into ideas because we can identify with the problem, but it's not a large problem for a very large segment of population, or even for a small segment, it is not a material enough problem. So either it should be a very large problem, material problem, or it should impact a very large number of users. So we should definitely validate that before starting out. The second is many times we take a little bit of a shortcut approach to team building in terms of building co-founders, but we should spend equally and maybe even more disproportionate amount of time that the team sticks together, people have complementary skills, and it is a team which can hold on for 5, 7, 8 years versus just a 12-year shortcut, and then you will figure the team out.
With that, it's a wrap on this special edition of Young Turks Back to the Basics. Keep watching this space. Tell us what you thought of our show. You can write to us on Facebook or on Twitter. Check out this entire video on YouTube. Till next time, thank you very much for watching.
Celebrating 15 years of Young Turks.